Advanced Audit and Assurance, September and December 2021 sample answers. We will have to move on to the part C. Audit procedures in respect of the Nakatomi building. Review board minutes for details of the reason for the purchase to understand the business rationale and confirm board approval of transaction. Agree the $15 million paid to the company's cash book and bank statement. Agree the carrying amount of property to Grupo Co's non-current assets register. To confirm the initial value of the property has been recorded appropriately. Obtain proof of ownership, title deeds, legal documentation to confirm that the company owns the building. Visit the building to obtain evidence of existence and occupancy of the building by retail establishments to confirm that the property has been appropriately classified as an investment property. Obtain and inspect rental agreements for the retailers who occupy the Nakatomi building to confirm that the property is not owner-occupied and it generates a rental income to verify classification. Ensure as to whether the company hosts any other investment property, and if so, confirm it is also held at fair value to confirm that the accounting treatment is consistent for all investment property. Discuss with management the rationale for the accounting policy choice to measure the property at fair value and confirm that the notes to financial statements state that this is the company's accounting policy. With regard to the expert appointed by the management to provide the evaluation for the buildings, obtain information to confirm the experience and qualifications held by the expert. Certify a certificate of registration with a recognized professional body. Obtain confirmation of the expert's independence from Gilbert Co. and its management team. Review the instructions provided to the expert by management and agree that the evaluation method is in accordance with IFRS requirements and can be relied upon as appropriate audit evidence. Obtain the final report issued by the expert and assess that the assumptions and methods used and conclusions reached by the expert are in line with the auditor's understanding of the business. Confirm that the expert's valuation has been used as the valuation recognized in the financial statements and investigate any discrepancies. Confirm that the valuation has been carried out at the reporting date and in accordance with the company's accounting policy. If the valuation is the different date to reporting date, assess the reasonableness of valuation reflected in the financial statements. Reperform any calculations contained in the expert's working papers. The ethical issues, potential sale of shares, the request for McLean Co. to perform a vendor due diligence service creates a conflict of interest. A conflict of interest arises when an audit firm provides the service in relation to two or more clients whose interests in respect of the matter are in conflict. Conflict of interest is related to objectivity. The ISBA International Code of Ethics for Accountants states that objectivity requires the professional accountant not to compromise professional judgment because of bias, conflict of interest, or the undue influence of others. It is the requirement of the code that the professional accountant shall not allow a conflict of interest to compromise professional judgment. In this case, the interests of Ripper Co. and Willis Co. will be conflicting. Willis Co. will want to purchase the shares for the lowest possible amount, and Martin Gruber will want to sell them for the highest possible amount. This creates therefore a significant threat to the objectivity of Mark Co., who may be seen to be acting in the interest of one party at the expense of the other. The problem is exacerbated by the nature of engagement. The audit firm may be privy to confidential information gained during their time as auditor of GRIPCO. If the audit firm were to divulge this to Willis Co., it would give them a potentially unfair advantage over the other client and would be a breach of confidentiality. In all cases of conflict of interest, the audit firm should make full disclosure to both parties and ask them both to confirm that they give permission in writing for the service to be provided. It is likely that one of the parties will refuse permission, in which case the service should not be provided. If consent by both parties were to be provided, McLean Co. could safeguard the threat created by this situation by having separate engagement teams who are provided with clear policies and procedures in maintaining confidentiality, having an appropriate reviewer who is not involved in providing either service to the two clients to review the work performed to assess whether key judgments and conclusions are appropriate. Using confidentiality agreements signed by the relevant personnel. Establishing separation of confidential information physically and electronically. The code states that providing a valuation service can give rise to an advocacy threat, which means that McLean Co. would be promoting the interest of their client in relation to the sale price, so impacting objectivity. Safeguards such as the following could reduce the threat to an acceptable level. Use of separate teams to perform the valuation service and audit of Group Co., and having an independent second partner review the audit of Group Co. There's also a risk that performing such a service would result in the firm assuming a management responsibilities, because if the audit firm performs the valuation service, they could be perceived to be performing a role of management, therefore not appearing to be objective from audit client. Assuming a management responsibility for an audit client is prohibited in the code. If McLean Co. were to value the shares, there is also a threat in relation to subsequent audits of Willis Co. and the new group which will be reformed, as in performing the valuation of Martin Gruber's share. They would subsequently be auditing their own valuation work when they audit the new group's consolidated financial statements. The self-review threat leads to the objectivity threat, as the audit team may lack professional skepticism in their audit of the investment in Willis Co.'s financial statements and over-rely on the valuation performed by colleagues from McLean Co. The self-review threat can be reduced to an acceptable level by the use of appropriate safeguards, including use of separate teams to perform the valuation service and the audit of Willis Co., and having an independent second partner review the audit of Willis Co. The code suggests that if the valuation would involve both significant degrees of subjective judgment and have material effect on the financial statement, then it is likely the valuation service should not be performed. McLean Co. should therefore carefully consider whether it is appropriate to perform the service, evaluating the potential materiality of the shares and the level of subjective judgment involved. Conclusion: these briefing notes have evaluated the audit risks relating to the audit of Group Co. and highlight the issues caused by this being an initial audit engagement. The many incentives for management buyers make this a high-risk audit. The notes also recommend audit procedures in relation to a new investment property and conclude that due to significant conflict of interest and possible restrictions in line with the ethical code, it is unlikely that McLean Co. can provide a vendor due diligence service to Gruber Co.